Hello, everyone. This is John Thomas, the Mad Hedge Fund Trader, with you again. Today, I'm going to teach you the five golden rules for finding a great options trade. And I'm going to throw in an extra leap school, how to make outsized profits with a leaps strategy. And I am broadcasting today from Silicon Valley, which is the center of the universe right now, and where 40% of the entire US stock market capitalization is based. So let's move on. Take out your pen and paper to take notes or start typing in your smartphone. Stay to the end of this presentation, and you'll receive an exclusive trade alert with a 95% success rate. It's time for you to start trading like a professional. Don't leave good money on the table. You've spent vast amounts of time, money, and effort becoming a trading expert. You know the difference between bids and offers, puts and calls, exercise prices, and expiration days. And you still can't make any money. Now what? When do you apply your newfound expertise? How do you maximize your reward while minimizing your risk? It's all very simple. Stick to my five basic rules, and money will start pouring into your trading account. It's really not all that hard to do. I did it, but it did take me a half century of practice. Hopefully, you can learn a little quicker. So, these are my five golden rules for finding a great options trade. Number one, know the macro picture. If you have a handle on whether the economy is growing or shrinking, you have a major advantage in the market. In a growing economy, you only want to employ bullet strategies like calls, call spreads, and short volatility plays. In a shrinking economy, you want to exercise bearish plays like puts, put spreads, and long volatility plays. Remember, the only thing that is useful for your trading is a view on what the economy is going to do next. We are all in the what's next business. Okay, now we have golden rule number two. Pick the right industry. You don't want to give yourself, do you want to give yourself another valuable edge? There are over 100 different industries listed on the US stock markets. However, only 5 or 10 at the most are growing decisively at any particular time. The rest are either going nowhere or are shrinking. They're legacy industries. In fact, you can find a handful of sectors that are booming, while many others are in outright recession. If you're a major hedge fund, institutional, or government, you may want to cover all 100 of those industries. Good luck with that. If you're a small hedge fund or an individual working from home, you will want to conserve your time and resources and skip most industries and only focus on a handful. Some traders take this step further and only concentrate on single, high-growing, volatile industries like semiconductors or even single names like Nvidia, Tesla, or Amazon. How do you decide which industry to invest in? Brokerage houses pump out more free research than you could consume in a lifetime. Government reports tend to be stodgy, boring, and out of date. Big hedge funds keep their in-house research confidential, although I do get some of it from time to time. The Mad Hedge Fund Trader solves this problem for you by limiting its scope to a small number of benchmark pathfinder industries like technology, banks, energy, cybersecurity, and so on, which are on very strong long-term growth paths. In this way, we gain a handle on what is happening in the economy as a whole while lining up rifle shots on the best option trades out there. We want to direct you to where the action is and away from where the action isn't, and we have a good handle on where the future earning prospects are. Doesn't hurt that I live in Silicon Valley and have done so for the last 35 years. Yeah, I've been in the Valley miracle from day one. And I get invited to test out a lot of the many new technologies before they're even made public. My Tesla Model S1 is a perfect example. I bought number 125 off the assembly line in 2010 and drove it all the way until I got T-boned by a GM Silverado pickup truck. I was going to donate it to the Smithsonian Institute. So much for that. That encouraged me to recommend a Tesla stock at $2 before it begins its historic run to $426. It was one of the best short squeeze plays I've ever seen. And, and that was back when most people thought the company would go bankrupt. I thought better. So, would you rather invest in these industries, leather saddles, buggy whips, or buggies themselves? This is actually a body by Fisher buggy, which is what they built before they made car bodies for General Motors. In fact, US leather was a Dow stock all the way up until 1928. Do you want to be investing in leather stocks now, which have kind of faded away, or the next big tech industry? Half of all listed companies are already in the buggy whip business. They just don't know it yet. Or would you rather invest in this? Uh, NVIDIA's Blackwell chips, which are going for $100,000 each now. It's unbelievable. Optimus robots made by Tesla or the Tesla stock itself. This is my first uh, Model S1 back in 2010. I know because I can see how young my daughter is, and that's the S1 that went to car heaven. Actually, the parts got recycled into other Teslas. Okay, so number three, the third golden rule is you need a micro picture that is ideal. Once you have a handle on the economy and the best industries, it's time to zero on the best individual companies to trade in or the micro call. It's always great to find a good target to trade in because positions in single companies can deliver double or even 10 times the returns compared to stock baskets like the S&P 500. That is because the market will pay a far higher implied volatility for the options of single companies than they will for the SPY. Remember also that you are taking greater risk in trading individual companies. The option markets will pay you for that extra risk. If the earnings come through as expected, everything is fantastic. If they don't, the shares can drop by half in a heartbeat. Large indexes buffer this effect, which is why they have far lower volatility and cheaper options. Of course, there are gobs of market research about individual companies out there on the internet, which you can get for free. Some of it is okay, but much of it is just outright garbage, and all of it is conflicted. Recommendations out there are either buy or hold. Uh, Sell recommendations out of Wall Street are as rare as hen's teeth. Brokers aren't Brokers are loath to issue a sell recommendation for a stock because it will eliminate any chance of a firm obtaining new issues business from that company. Who wants to hire a broker to sell a new stock when the analyst has already dissed the company in his research reports? And brokerage firms don't make their bread and butter on those piddling little commissions that you pay them, if you pay them at all. They make it on highly lucrative new issues business. In fact, a new issue can earn as much as $100 million for the lead manager. I know because I've done it myself when I was at Morgan Stanley. I have been following about 100 companies in the leading market sectors for well over half a century. Some of the managements of these firms have become close friends over the decades, so I generally uh, get first class information. When markets rotate to sectors and companies that I already know, I have a huge advantage. Needless to say, this gives me a massive head start when selecting individual names for options trade alerts. Golden rule number four, the technicals line up. I have never been a huge fan of technical analysis. Most technical advice boils down to if it's gone up, it'll go up more, or if it's gone down, it'll go down more. Thanks a lot for that. Over time, recommendations are accurate about 50% of the time, or about equal with a coin toss. However, the shorter the time frame, the more useful technical analysis becomes. If you analyze intraday trading, almost all very short-term movements can be explained in technical terms. 200-day moving average, 50-day moving average, blah, blah, blah. This is entirely how day traders make their livings. It's a classic case of enough people believe something, it becomes true, no matter how dubious the underlying facts may be. So it does behoove us to pay some attention to the charts when executing your trades. Talk to old-time investors, and you'll find that they use fundamentals for their long-term stock selection and technicals for their shorter-term execution. Talk to them some more, and you'll find out that the best fundamentalists sound like technicians, while the savvy technicians constantly refer to underlying fundamentals. Get the technicals right, and you can provide one additional reason for your trade to work. Golden rule number 5. The calendar is favorable. There's one more means of assuring that your trades turn into winners. I'm a big fan of buying straw hats in the dead of winter and umbrellas in the searing heat of summer. There is a method to my madness. Have you heard of sell in May and go away? According to the Stock Traders Almanac, 10,000 investors, $10,000 invested in the beginning of May and sold at the end of October every year since 1950 yielded you absolutely nothing. This is despite the fact that the Dow average has rocketed from $409 to $50,000 during the same time period, a gain of 122 times. Amazingly, $10,000 invested every November and sold at the end of April would be worth an incredible $702,000. It gets even better. Of the 62 years under study, the market was down 25 of the May to October periods, but down only 13 of the November to April periods. What's more, the market has been down only 3 times during the November to April period in the last 20 years. And I bet you know what those 3 years are. It turns out those 3 times when the good 6 months lost money were 1969, 1973, the oil shock, and 2008, the financial crisis. When the bad 6 months time period, there have been 11 losing losses of 10% or more. So it's clear that trading according to the calendar can have a significant impact on your profitability. Being a longtime student of the American and indeed the global economy, I've had a theory behind the regularity of this cycle. It's enough to base the pagan religion around, the one practiced by the Druids at Stonehenge, which I'm going to be visiting in another month. Up until the 1920s, we had an overwhelmingly agricultural economy. Farmers were always at their maximum financial distress in the fall when their outlays for seed, fertilizer, and labor were the greatest, but they had yet to earn a penny from selling their crops. So they had to all borrow at once, placing a huge strain on the financial system as a whole. This is why you always seem to have so many stock market corrections or crashes in October. Once the system swallows this borrowing lump, it's nothing but green lights for 6 more months, i.e., October to May. After the cycle was set in stone, it was essentially identifiable by computer algorithms. The trend became a self-fulfilling prophecy. Yes, it may be disturbing to learn that we ardent stock market practitioners might, in fact, be the high priests of a strange set of beliefs. But hey, some people do anything to make a buck. It's important to remember that this cyclicality is not 100% accurate. And the one time you bet the ranch on sell in May and go away, it won't work. So you really want to buy low and sell high. It's my new trading strategy. I'm thinking of patenting it. You want to do option trades in very high implied volatility stocks. Those would be MicroStrategy, which is a Bitcoin treasury stock. That has an implied volatility can go from 80% up to 100%. Silver, the SLV, has a 50% implied volatility, and Tesla's at 46. The low end you want to avoid. AT&T is only 20%, the S&P 500 is 17%, and the bond market, the TLT, heaven forbid, has the implied volatility of under 10%. So you know where the action is in the options market. There are tailwinds to your trading, which you can add on to the five golden rules. Adopt these simple disciplines, and you'll find your success rate jumps from a mere 50% coin toss to 70, 80, or even 90%. If a potential trade meets only four of these five criteria, please do it with your money and not mine. Your chances of making money have just declined. Get the tailwinds of the economy, your industrial call, your company pick, the market technicals, and the calendar working for you, and all of a sudden, you're a trading genius. It only took me a half century to figure this out. Hopefully, you can do it quicker. There's one more way to maximize your profit, and that's to go to Leap School. What is Leap School? Well, let me tell you, it has nothing to do with ballet or yoga or anything like that. Leaps are long-term equity anticipation securities. They minimize your risk while maximizing your profits. They are an ideal strategy for high growth companies. They give you a very low risk with a very high return. They're only issued when the highest growth, best quality stocks reach extreme oversold conditions. It is where the big money in the markets is made. So let's go to look at three different leap strategies, and I'll give you specific examples that we've done in recent years. And I'll start out with my standard leap, which has only a 100% profit if the stock remains unchanged for a year. Yeah, you can earn that much money in a stock that does nothing. So this is the alert we sent out. We bought the Goldman Sachs June 2024 320, 330 at the money vertical bull called debit spread leaps for $4.50. The expiration date was June 24th, 2024, and we simultaneously executed these two trades. We bought the 320 calls for $42. We sold short the 330 calls for $37.50. That gave us a net price of $4.50. Potential profit on this trade, well, we bought it for 450, expires in a year at 10 bucks. Our net profit would be $5.50 or 122% in 15 months. Let's see what happened with this leaps. Well, let's score it first. How many of my rules did I actually follow? Well, the macroeconomy was good at the time. The US economy was growing at 3%, so the market would be expanding. We'd be in a bull market. In the industry, the banking industry is not only one of the cheapest industries in the entire S&P 500, they are also one of the fastest growing. And as long as that anomaly is true, I'm going to keep piling on leaps in the banking sector. Goldman Sachs just so happens to be the best managed company in the industry, if it's not Morgan Stanley. And often I'm doing leaps in both Goldman Sachs and Morgan Stanley, where I worked for 10 years. Uh, the calendar, March isn't the best time to add new trades. So this is why I only gave this trade a B plus, but it had an implied volatility of 40% at the time, and that makes it a go. So also when I send out my trade alert, I send you a screenshot from my personal trading platform. And this shows you how to execute this trade on your own platform. I'm buying the June 24 320 calls, and I'm selling short the 330 calls. The net price for that trade at the time was $4.50. Looks good to me. Don't forget, people make lots of mistakes when putting these up. Even I make mistakes sometimes. You want to check all the numbers. You're buying the 320s, you're selling short the 330s. The expiration date down here, June 21st, and your number of contracts here, I always use one on the leaps so people can tailor the size to their own account. And we get a few extras here. On this particular day, the historic volatility was only 29%. It actually increased a lot after that. So what happened to this trade? Well, this is when we put it on. Goldman Sachs, the technicals were lining up. How about that? Look at this. We had a double bottom setting up here right around the 290, 300 level. So I thought, aha, we attack with a leaps. What did the Goldman Sachs do after that, after we added this position? Well, we absolutely went through the moon. Stock went from, this is another extra tailwind we got. Interest rates were stable. In fact, interest rates haven't moved for 4 years. Look at this complete sideways move on the TLT, 10-year US Treasury yield. So that is another extra tailwind for this trade. So what did we do? Well, we added the leaps back here, right around 300 in the stock. After that, it went to 948. So we would have made that profit even if we had gone sideways. We only needed to go up to 330, which is right here, in a year to make the maximum profit. As it happens, this stock tripled in the following 2 years. And in fact, we've been issuing Goldman Sachs call spreads almost every month since then. But the people who got in on the leaps, they got 122% profit in a stock that tripled. So let's see, we want to take on more risk. Well, how would you like to make a 200% profit in a stock that rises 30% in a year? With all the high growth tech companies abounding these days, finding a 30% move isn't really that hard to do. You do these kind of trades, you get to do things like collect vintage Rolls Royces like I do and show them at the Pebble Beach Car Show every year. So let's look at our 200% return. We bought the Occidental Petroleum January 2026, 60, 62 and a half out of the money, not at the money, but out of the money, vertical bull call spread leaps at 80 cents or best. This is the issue date, October 2nd. It expired Jan 16th, 2026. And here's the spread. We bought the 60 calls for $5.25, sold short the 62 and a half calls for $4.45. Our net cost on the combination is only 80 cents, and this expires worth $2.50. That would give us a profit of 212% in 15 months. So let's see how we set this up. Well, U.S. economy, again, growing at 3% when we set it up in 24. Any geopolitical shock out of the blue would cause oil prices to skyrocket and therefore Occidental Petroleum. So a lot of managers use oil trades as a hedge against the rest of the portfolio in case we get a geopolitical shock out of the blue, like, for example, an attack on Iran. How about that? Or a closure of the Straits of Hormuz. Occidental Petroleum is the prime oil company in California. I know it well, been covering it for over 50 years. Calendar, October, best time of the year to add new trades. Tailwinds, oil prices were trading at close to historic lows. So plenty of upside opportunity. That gives this trade an A plus rating in my 5 golden rules. So this is how we set up the trade. We bought the 60 calls. We sold short the 62 and a half. The net cost of the combo is 80 cents. And there's the January 16th, 2026 expiration. What happened next? Well, we bought the leaps right here at this low. After that, the stock rose more than 30%. And it expired right above our maximum profit point, and that gave us a 212% profit. So again, another successful leaps. People love these. We had several of these on in Occidental Petroleum, ExxonMobil, and Schlumberger going into the Gulf War, and they all proved enormously profitable. So let's say a 200% profit is not enough. You want to make 1,000% on a trade on the assumption that a stock will double in a year. Well, let's take a look at what you can do in the market. Uh, you buy the NVIDIA Jan 2025 270 280 out of the money call spread for 50 cents. That was the price you could buy NVIDIA on September 29th, 2022. Remember, NVIDIA has since split 10 to 1. So we're actually buying the stock in terms of current prices, the $27, $28 call spread. Um, so this is how you set it up. Buy one January 270 call for $11. Buy one 280 call for 10.50. Your net cost is 50 cents, and the potential profit here is $9.50 or 1,900% in 2 years and 4 months. Sounds like an insane bet. Um, let's see how we set it up. Well, the macro scorecard again is another A plus. U.S. economy still growing nicely. NVIDIA, the with AI just getting started, the demand for GPUs that NVIDIA makes is about to skyrocket. NVIDIA is the top designer of GPUs in the industry. Autumn is a great time to add new trades like this, and we were just on the eve of the AI boom. So what happened? Well, this is the setup here. Bought the 270 calls, sold short the 280 calls, cost 50 cents, expiration January 17th, 2025. Okay, so technicals lined up very nicely. Um, Not only were we getting a double bottom on the stock, but we had major support from the 200-day moving average right here. Remember, in current stock terms, this is $12.73 for NVIDIA. Yes, you're kicking yourself. Where was I in 2022 when I should have been buying NVIDIA stock? So what happened? Well, we all know what happened. This is the largest company in the world now. We bought NVIDIA down here. It kept going up. But you don't care if it keeps going down because this had a 2 year expiration. So we had all the time in the world for this to work. What happened? Well, it worked big time. We got our double up here. The stock went from $12 all the way up to 30. So that's almost a triple. And that's where we got our 1,900% profit. What happened then? Well, it kept on going. As we all know, it made it all the way up to $240 a share or $2,400 in split adjusted terms. And I actually had one client when I sent this trade out 4 years ago. He said, "Oh no, you're being way too conservative. I'm going to do the farthest out of the money strike with the narrowest spread on NVIDIA." And you know what? He put 1 million into the trade. He made $50 million profit on NVIDIA, and then he retired and never worked again. And I don't hear from him anymore. But that is the kind of leverage, 50 to 1, turning a million into 50 million that you can do with a leap strategy in the right stocks at the right time. So it's not just stocks that take leaps. You can also do bonds, foreign exchange, commodities, precious metals, oil, and real estate. All of these have ETFs and options, which means they can be converted into leap strategies. So, for example, let's say we had a bullish view on gold, which we here at Mad Hedge Fund Trader have had for the last 5 years. Well, maybe Barrick Gold will go up if we do get a bull market in gold. So we put out this trade in 2023. We bought the $20 calls in Barrick Gold, which at the time was the world's largest gold miner. We sold the 22s. This gave us a potential 298% profit in 18 months. What happened? Well, gold went absolutely through the roof. You can see how we set it up. Bought the 20, sold short the 22s for 46 cents. Jan 17, 25 expiration. This is where gold was when we put it on. And this is the old Barrick gold symbol. Currently, the symbol is a B. It was down here at 16. So nice technical support here. It was holding at the 50-day moving average. All we had to do was to break through to 200-day the upside, and then it was off to the races. What happened? It was off to the races. Here's the new symbol, Garrett Gold. This is where we put the trade on back here. We had a really boring year when it really did nothing because interest rates were so stable. Gold is very sensitive to the movement of interest rates. Um, but once interest rates started to drop, it was off to the races again. And the stock went from 16 all the way up to 54. We got our 298% profit. We rang the cash register, said thank you very much, and went on to the next trade. Um, let's say you had a really negative view on bonds, and you could have done a put spread leap on the TLT all the way up here at 132, and it fell all the way down to 75. So that is a 60-point drop. And this would have been a perfect setup for a 1,000% return. You could have bought, say, for example, the 102 100 vertical bear put spread. That would have delivered a 1,000% return on the way down, and then it went sideways. Copper, you could have played it on the long side. And this is the copper ETF. It went from $3.20 all the way up to 620. You could have bet down here that copper wouldn't go any lower for a year and made a 100% return. You could have bet that copper would rise 30% and you would have made a 200% return. And you even could have made the 1,000% return doing something like the 5-520 call spread out 2 years, and that would have made you a 1,000% return. Here's another one, foreign currencies. I've been bullish on the Australian dollar for years, and I think it's eventually going to go to 1 to 1. So you could have bought uh, a 2 year leap on the Australian dollar when it was triple bottoming at $60 here, here, and here, and then gotten at least a 300% return on any kind of long call spread setup in this area. So again, you can also use leaps in foreign currencies. And you can do it in other precious metals like silver. We all know how ballistic silver went from $15 an ounce up to 140. So 2,000, 3,000, 10,000% returns were possible here. And of course, oil, another great hedge to have on board. You could have put on a bet down here that oil wouldn't trade below $60. And in fact, it went to 140. So you can also play in the commodities markets with this leap strategy. And let's say you think there's going to be a housing recovery. Could have put on a leap down. In fact, we did put on a leap down here when D.H. Horton was trading in the 70s, and we got a almost a triple on that all the way up to 190. So this could be a fantastic leap candidate if interest rates start to fall again. Right now, they've been rising all during this period, and the stock has been a no touch. So there's another little secret that you can take advantage of here, and that's that algorithms frequently go crazy. And in this particular case in the USO, we had a $3 range in the USO, or little bit less than 3% inside of 1 minute. And this is the argument for putting low ball orders to buy securities. In the case that you get one of these extreme moves, um, let's talk in terms of just buying the uh, USO outright. Let's say you had an order in to buy the USO at, say, 133, you would have gotten filled. But let's say you wanted to take profits on something, you also could have put it in order to sell at 135. These get executed automatically uh, whenever there's an extreme news move on a news event. And in this case, you had different algorithms taking stuff both up and down at the same time on the same news flash. So this is how you get fantastic executions when entering your orders, especially on illiquid things like leaps. So here, that is another trick of the trade. In fact, there are hedge funds set up that do nothing but put extremely low bids, extremely high offers every day on the same security, day in, day out, in the hope that one of these things will happen. So over 5 years, I've issued 45 leaps to my followers. 44 of these made money. And this is me at Iguazu Falls in Argentina, where I was just a couple months ago. And what was that one losing leap? It was in natural gas. Oh, natural gas. Back here, I thought um, that the UNG, the natural gas ETF, was bottoming. It did not. What happened is U.S. Fracking companies kept ramping up production, pushing prices down lower and lower and lower, and we ran out the life of a 2-year leap right here, and it was a total loss. It does happen occasionally. So keep this in mind when you're picking your individual securities and picking your strike prices for your leaps. Sometimes these things do go to zero. In my case, it's 1 out of 45. I can live with that, especially if the winners are going up 100%, 300%, or 2,000%. Um, Also, another argument for not putting all your money into one leap, because that will always be the one that goes to zero. And this is despite me working in the natural gas industry for 6 years. Uh, we just, nobody saw the overproduction coming to the degree that it did. So, this is what Mad Hedge Fund Trader can do for you when setting up leaps. We provide the right timing on when to add new trades. Hint, now is not a good kind of time to add trades because the market's at a new all-time high, but a summer correction would be an excellent time to add a new uh, leap strategy. And it's June now. We picked the winning industries for you. I've been following the same industries for 50 years, so I know them very well. I know the best companies in each industry to pick. I'll remind you of the calendar risk, and I also will screen the best implied volatilities in the options market so you can target your leaps at the highest implieds. This is our secret weapon, our Mad Hedge Market Timing Index. Today it's at 60. It's an artificial intelligence-driven algorithm that analyzes 30 different economic, technical, and momentum-driven indicators all day long. Took a team of mathematicians, 1,000 hours of calculations to create this one algorithm. And right now it's showing that the market is overbought and ready for a correction. This is 1 year of market timing index readouts, and you can see we are at an extremely high risk position right here, equal to the top that we saw in January and the top that we saw at the beginning of last summer. So you can see we topped here, then the Iran war hit. That created the best buying opportunity in a year on April 1st. So the smart thing to do is subscribe to my service, watch this indicator. Next time we get down to here, you jump in and buy with both hands. Why do you need an algorithm? Well, why use a toolbox missing its most important tool? Algorithms have become so dominant in the market, you should never trade without one. It does the work of a seasoned 100-man research department in seconds. It runs real time and optimizes returns with the addition of every new data point far faster than any human can. Imagine a trading strategy that upgrades itself 1,000 times a day. Don't go to a gunfight with a knife. If you're trading against algos alone, you will lose. Algorithms provide you with a defined, systematic trading discipline that will enhance your trading profits. This is 3 years of market timing index. You can see we get buys at market bottoms, sells at market tops, buy, sell, buy, sell. It's like having a money printing machine. I'm not the only one using algorithms. Some 80 to 90% of all current trading is algorithm driven. Obviously, the message here, you get into the right market timing and you get to buy your own mega yacht. This particular one, Perfect Trade, uh, is named after a trade that my customer did 10 years ago. So how would you like to become a successful investor? Trade for a living full time, pay for educations, cover medical bills, pay off mortgages, not just for you, but for your entire family. Follow the rules, the five golden rules to bring in the best performance in the industry. This is my trailing 1 year return, 62.83%, which is more than double what the market has done. And this is my average annualized return for 20 years. We've averaged 49.69% versus 29.77% for the S&P 500. So why listen to John Thomas? Well, I have 55 years of experience in the global financial markets, 10 years as the economist correspondent in Tokyo and later the White House, 10 years running the international equity division at Morgan Stanley, Marine Corps combat pilot in Desert Storm, 10 years running the first international dedicated hedge fund, 5 years fracking for natural gas in Texas, and now 20 years publishing the Diary of a Mad Hedge Fund Trader. I am one of a handful of founders of the modern hedge fund industry who is still working and breathing. I'm also registered with the U.S. Securities and Exchange Commission, also registered as a commodity trading advisor with the U.S. CFTC, registered as an investment advisor in the state of California, passed the Series 7 securities test, the Series 63 test. We don't take any commissions or kickbacks from anybody in making this presentation. For us, the big payoff is renewals from happy customers, of which we have many thousands. Uh, okay, we have this. You need me to, uh, you need a real pro to guide you through the market maze. The market is not monolithic, and 95% of it can be completely ignored. There are a few great sectors and a lot of awful ones. You can earn a 10x return on the great ones, but get wiped out by the losers. Let a 55-year veteran steer you to safe waters. Let me sit next to you and guide your hand with every winning trade. So what do we do about all this? Well, stocks, you want to sell rallies. Bonds, you want to sell rallies. Commodities buy dips. Energy buy dips. Foreign currencies buy dips. And precious metals buy dips. If you're not up 62.83% in the past 12 months, as I was, you are reading the wrong newsletter or following the wrong trade mentoring service. Um, Sit with me, John Thomas, the Mad Hedge Fund Trader, in my Global Trading Dispatch. Discover how you can tap into the top performing trade mentoring service in the industry, up 62.83% in a year. Follow my research and market beating trade alerts, and you will rake the profits in. Let a Marine combat pilot steer you to big profits. We trade single stocks, options, and ETFs for global equities, bonds, foreign exchange, energy, commodities, precious metals, and real estate. If you don't have adequate experience in the options market, don't worry. Our trailer works also work just for stocks and ETFs, and we're more than happy to teach you how to do the options trades. This is a typical record of our trade alert service. You can see we made 16% on the S&P 500, 8% on the TLT, 14% on the Russell 2000. Then we lost 21% on Biogen. We stop out of losers very quickly. It's easier to dig yourself out of a small hole than a big hole. And you can see the rest of the trades we did that month were profitable. With my Mad Hedge Global Trading Dispatch, you get instant trade alerts sent out at market sweet spots, about 200 a year, and all the reasons to execute them. Live biweekly strategy webinars with an interactive Q&A highlighting the next trading opportunities, special reports on urgent investment topics, invitations to strategy luncheons around the world. Get trading ideas on a daily basis. I'll even teach you the name of a surfing school in North Africa. Warning, it's a lot harder than it looks. This is the one-stop shop. It's for individuals who want to understand what is happening with their retirement plans. It's for people who want to learn how to trade for a living, get the financial education of a lifetime. It's for small institutions and financial advisors who can't afford an in-house research department. Get in before the next melt up begins. Um, okay. Um, Subscribe to our service. You also get invitations to our global luncheon schedule. And you can see the next several months, I'm going around the world meeting with my customers. I'll be in New York, London, Amsterdam, Vienna, Zermatt, Switzerland, Istanbul, Turkey, Sydney, Australia, Brisbane, and Honolulu, Hawaii. So this is what I'm not going to charge you for this service. I'm not going to charge you $100,000. That's what I charge my big hedge fund clients, and they're happy to pay because I make them millions of dollars. Um, Not for you. Creating this product cost me millions of dollars. With the best customer service in the industry, it costs millions just to keep it running. This is the offer. You can't refuse 6 months for just $997. Just click on the link on the chat box on the right. That'll take you to a dedicated sales page, only available at today's webinar. This is a limited time offer. It's a highly personalized service. I only can take 25 new subscribers at a time. So it's first come, first serve. I can't wait to make you a top drawer trader. Just click on the chat box on the right. Let me make the money for you to pay for your subscription. You make the trades, discover how an experienced hedge fund manager finds and exploits the best sweet spots in any market. 6 months for just $997. Buy now, and you will instantly receive a leaps trade with an extremely high probability of success that you can execute immediately and make some of the most serious money in your life. Don't leave good money on the table. And just to give you a tease, this is the chart of the leaps that I'm about to send out to people who sign up for my service today. So let's go flying. When you make millions of dollars for your customers, you get a lot of pretty interesting invitations. $5,000 cases of wine, lunches on super yachts, free tickets to the Olympics, and dates with movie stars. So it was in that spirit that I made my way to Albuquerque, New Mexico to participate in the annual balloon festival to meet concierge subscriber James Branson. When I first met James years ago, he was toiling away trying to make a cattle ranch in Arizona pay, unsuccessfully so. He signed up for my entry-level global trading dispatch and started booking winning trades by the hundred. After only a few years, he'd made enough money to sell his ranch and pursue the love of his life, hot air ballooning. He set up a business to take tourists into the air, starting out with a modest 6-passenger balloon. By the time I met him, he'd graduated to a monster 16-passenger airship that was over 100 feet high. And let's run this again. It was a crystal clear morning when he let me pilot the balloon up to a breathtaking 9,000 feet over the New Mexico desert. Let me make millions of dollars for you as well as I have done for thousands of other followers over the last 20 years. I look forward to working with all of you. Okay, this is our final page here. There's the link. In case you can't access the sales page, you can just copy and paste this into a browser, and that'll take you directly to the offer I'm making today. Let me check my store right now, see how many spaces we have left. And just a minute. We have Eric from Flagstaff, Arizona, has just signed up. Eric, thank you very much. Promise to work hard for your money. And please check your inbox. The trade alert should be in there right now. We have Frank from Columbus, Iowa. Frank, thank you for your confidence. And if you can't find the trade alert in your inbox, um, then just go to your junk folder. Sometimes if you're a brand new subscriber, that's where the trade alerts go. We have Peter from Shreveport, Louisiana. Let me open another one here. Lance from Bemidji, Minnesota. We have Judy from Memphis, Tennessee, and Ian from Cambridge, England. Okay, that's it for today. This is the offer you can't refuse. Today and only through this webinar, 6 months for just $997. Let me show you how to make the money to pay for your own subscription, which 90% of our subscribers do with their first trade alert. Here's if for some reason you can't find the link in the chat box on the right, this is where you need to go to get to today's dedicated sales page, only available to today's webinar. Okay, so I have a few extra minutes here to take questions. I'm going to go ahead and answer questions until I run out of time. Once I get into a leap, can I come out at any time? Yes, you can. You can get prices for these leaps every day. The day-to-day changes are minimal because the net delta on these things are only about 6% or even 5%. That's because you have a long offsetting a short. However, these are illiquid securities. So sometimes if you're in a hurry to get out, you may need to put in a limit order uh, 5 or 10 cents below the indicated price. That gives room for the market makers to get into your position, take it off your hands, and then flip it. Are leaps liquid or illiquid? Well, I just covered that. They're all illiquid. We're looking at options that are out 6 months, a year, 2 years, even 2.5 years. Uh, so they trade by appointment only, and you have to just put in a limit and either wait for the market to go your way, in which case your limit order becomes the bid side of the market, or for the underlying security to go your way. Let's see, can you get your short leg called away with leaps? Yes, you can. If you are short an option on the CBOE, that short position can be executed at any time and called away, which means you need to come out of your total position or you'll get hit with a margin call. Normally, options called away only happen into the final week of the life of an option. So it doesn't become a leaps issue. But I have seen leaps called away a year before expiration. It happened once with the TLT with a client, and he couldn't believe it. He made 100% on his position in one day. Yes, weird things happen in the options market. People make mistakes. Algorithms make mistakes. Algorithms get badly designed. And sometimes if you have an order out there for sale, and some people do put in limit orders for the very long term every day, occasionally they get lucky and get filled with a flash crash or something. Okay, next question. How important are implied volatilities when picking leaps? Well, it's very important. The higher the implied volatility, like 80%, 90%, or 100%, is the more you get paid on the short side of the transaction, which means the bigger the return on 1 year, 2 years you get on the leap. So we try to focus our leaps in the highest implied volatilities in the market. This year, that's been oil. Last year, it was Bitcoin. Next year, it'll be something else. And we try to avoid the low volatility stocks like AT&T, like the S&P 500, where the payoff is minimal. Okay, another question here. Can I make money on a leaps if the stock doesn't move in a year? In fact, for my lowest grade, most conservative leap, the profit is 100% in a year if the stock doesn't move. Now, 80% of the time, the stock market goes up. Getting a stock to remain unchanged or better for a year is a complete no-brainer which is why 44 out of 45 of my leaps have made their maximum profit. But strange things happen, like oil crises, Iran wars, financial crises, pandemics, and that is where you could get hit with an out of the blue loss on your leap. So if something really bad looks like it's going to happen, it might be good time to take profits on your leaps. And in fact, I've been taking people out of leaps in Apple and Palo Alto networks because we have 80 to 90% of the profit in hand. Why hang on for another year or 6 months for the last 10 cents? As my old mentor, Barton Biggs, used to tell me, always leave the last 10 cents in a trade for the next guy. Another question here. How do I calculate the net implied volatility of a leap's position? Well, very simple. If you have, you take your implied volatility on your short side and subtract the implied volatility from the long side. So you might be doing a 50% minus 45%. That'll net you about 5%, which is the normal implied volatility for a leap. And if you don't understand that, call customer support. It is kind of complicated to understand. Okay, let's see. What else do we have here? Questions. Um, do I have to buy any additional software or third-party data feeds to take advantage of your leap strategy? No, you don't. All standard options trading platforms have everything you need. We just tell you exactly which stock you need to do, which strike prices, when to do it, all available on your online platforms, whether it's uh, Tasty Trade, Lost Dog, uh, Morgan Stanley, Goldman Sachs, just your one account. I have all the extra expensive data feeds I need to make those recommendations. I've already paid for those. Some of those are quite expensive. You don't have to worry about it. Okay, well, that is pretty much it for today. I'm running out of time. This is John Thomas, the Mad Hedge Fund Trader, signing off for today. Good luck and good trading.